Welcome back to The Long Game. I'm Nathan Carter. Yes, this voice is AI, but the ideas we talk about are deeply human and built to help real-world investors make wiser decisions. Today's question is as old as investing itself. What is a business truly worth? You might find a great company, strong brand, wide moat, clear mission. But if you pay too much, even the best business becomes a bad investment. So how do you know when the price is right? This is where we talk about valuation. Let's start by breaking the myth. Valuation doesn't have to be complicated. You don't need 20 tabs of Excel or an MBA. At its core, valuation is about one thing. How much future cash is this business likely to generate? And how much are you willing to pay for those future dollars? Imagine this. You're buying a farm. It makes $10,000 a year. Would you pay $100,000 for it? Maybe. That's a 10% return. Would you pay $200,000? That's a 5% return. What if interest rates rise? What if crop prices fall? You see, the price you're willing to pay depends on your expectations, your alternatives, and the risks. The same logic applies to businesses. Now, let's talk about two simple tools you can use as a value investor. The first is the PE ratio, price to earnings. Let's say a stock trades at $100 and it earns $5 per share per year. That's a PE of 20. What does that mean? It means investors are willing to pay $20 for every $1 of earnings. Is that good or bad? It depends. If the company is growing fast and has a wide moat, a PE of 20 might be cheap. But if earnings are falling or the moat is shrinking, that same PE could be expensive. So PE is a starting point, not the answer. Here's where the second tool comes in: discounted cash flow, or DCF. Sounds intimidating, but here's the idea. You estimate the cash a business will make over the next 5, 10, 20 years, and then discount it to today's value. Because $1 today is worth more than $1 tomorrow. Why? Because of inflation, because of opportunity cost, because of risk. So we apply a discount rate, usually around 8 to 10%, and calculate what those future dollars are worth today. It's like this. You're not just asking, how much money will I get? You're asking, how much is that money worth to me right now? If the total value of those discounted future cash flows is higher than today's stock price, you might have a good deal. If it's lower, the stock may be overvalued. Now here's a key principle in value investing: margin of safety. Even if your analysis is solid, the future is uncertain. So you want a cushion. If you think a stock is worth $100, maybe you'll only buy it at $70. That's your margin of safety. It protects you from surprises. Unexpected expenses, bad quarters, new competitors, black swans. Because they happen. Even great businesses stumble. Let's take a real example. Apple. Back in the early 2000s, Apple was priced as a struggling tech company. But some investors saw a growing brand, a loyal customer base, a culture of innovation, and most importantly, it was cheap. When the iPhone launched, everything changed. Those who bought Apple with a margin of safety not only survived the ups and downs, they thrived. Here's another example. Zoom. In 2020, it exploded. Valuation went through the roof. But even though the product was excellent, the price baked in perfection. No margin of safety. And when growth slowed, the stock fell. Not because the company failed, but because expectations were too high. That's the lesson. It's not just about finding great businesses. It's about not overpaying for them. Remember this quote from Warren Buffett. Price is what you pay. Value is what you get. So always separate the two. A $500 stock isn't necessarily expensive. A $5 stock isn't necessarily cheap. What matters is what you're getting in return. Now, let's bring it down to a question you can ask any time you look at a company. If this company were private, would I still want to own it at this price? Imagine no ticker symbol, no daily price swings, just the business and its future cash flows. Would you buy? Would you hold? Would you feel safe? That's how you think like a value investor. Let's close this episode with a checklist, a mental model you can apply. 1. Understand the business. If you don't get how it makes money, stop. 2. Identify the moat. What protects it from rivals? 3. Assess the numbers. Is it profitable? Is it growing? Are margins stable? 4. Estimate future cash flow. What might this company earn 5, 10, 20 years from now? 5. Discount to today's value. Use a conservative rate. Don't assume perfection. 6. Apply margin of safety. Aim to buy below fair value, not at or above. 7. Think like a business owner. Would you be proud to own this business? That's the long game. Not chasing trends, not following hype, but slowly, patiently buying great businesses at fair or better prices. Because time, not timing, is your greatest ally. Thanks for listening. I'm Nathan Carter. And as always, invest with clarity, think long term, play the long game.